Welcome to Muscular Brain Fat Wallet. Today, we're diving deep into the fascinating world of real estate investment trusts, or REITs. Whether you're a seasoned investor or just starting your financial journey, understanding REITs can be a game changer in your investment strategy. In this video, we'll cover everything you need to know about REITs, from what they are and how they work, to their benefits and risks, and even how to get started investing in them. So, if you're ready to unlock the potential of real estate investing without the hassle of being a landlord, let's get started. What are REITs? Let's begin with the basics. What exactly are REITs? A real estate investment trust is a company that owns, operates, or finances income-producing real estate. They provide a way for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. History of REITs. The concept of REITs dates back to the 1960s in the United States, aimed at giving all investors access to income-producing real estate. The first REIT, the equity REIT, was created in 1960. Over the decades, REITs have evolved and now encompass various sectors, including residential, commercial, industrial, and specialized properties. Types of REITs. There are three main types of REITs. Equity REITs. These REITs primarily invest in and own properties, generating revenue through leasing space and collecting rents on the properties they own. Equity REITs tend to focus on a specific sector, such as retail, residential, or healthcare. Mortgage REITs, MREITs. These do not own properties directly. Instead, they provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. They earn income from the interest on these financial assets. Hybrid REITs. These combine the investment strategies of both equity REITs and mortgage REITs, investing in both properties and mortgages. How REITs work. Now that we know what REITs are, let's explore how they work. Structure of REITs. REITs operate like mutual funds, pooling money from many investors to purchase and manage real estate. To qualify as a REIT, a company must adhere to specific regulations set by the IRS, such as distributing at least 90% of its taxable income as dividends to shareholders. This requirement makes REITs a popular choice for income-seeking investors. Legal requirements. In order to maintain their status as a REIT, these companies must also invest at least 75% of their total assets in real estate and derive at least 75% of their gross income from real estate-related activities. How to invest in REITs. Investors can purchase shares in publicly traded REITs through stock exchanges, much like any other stock. Non-traded and private REITs, however, may be available through brokers or financial advisors and often have higher minimum investment requirements. Benefits of investing in REITs. So, what are the benefits of investing in REITs? Income generation. One of the primary attractions of REITs is the income they generate. They are required to pay out at least 90% of their taxable income as dividends, leading to attractive yields that can provide a steady income stream for investors. Diversification. Investing in REITs allows for diversification in an investment portfolio. Instead of investing in a single property, you gain exposure to a portfolio of real estate assets across various sectors and locations. Accessibility and liquidity. REITs are more accessible than direct real estate investments. Investors can buy shares in publicly traded REITs with relatively low capital compared to buying real estate properties. Moreover, because they are traded on exchanges, REIT shares can be bought and sold easily. Potential for capital appreciation. In addition to income, REITs can also offer capital appreciation. As the value of the underlying properties increases, so can the value of the REIT shares. Risks associated with REITs. However, as with any investment, there are risks associated with REITs. Market risk. REITs are subject to market fluctuations. The value of their shares can go up or down based on market conditions, regardless of the performance of the underlying properties. Interest rate risk. Because REITs often rely on debt to finance property acquisitions, rising interest rates can increase their borrowing costs and impact profitability. Higher interest rates may also make other income-generating investments more attractive, potentially reducing demand for REITs. Management risk. The performance of a REIT largely depends on its management team. Poor management decisions can lead to underperformance and affect dividend payouts. Sector-specific risks. Different sectors of real estate can face unique risks. For example, retail REITs may struggle if e-commerce continues to dominate, while healthcare REITs might be affected by regulatory changes. How to invest in REITs. If you're considering investing in REITs, here are some steps to help you get started. Different ways to invest. You can invest in publicly traded REITs, which are bought and sold on stock exchanges, non-traded REITs, which are registered with the SEC but not listed on exchanges, or private REITs, which are not registered with the SEC and typically available only to accredited investors. Factors to consider. When selecting a REIT, look for factors like the REIT's historical performance, the quality of its management team, its dividend yield, and its strategy. You should also consider its asset diversification and geographical exposure. Evaluating REIT performance. To assess a REIT's performance, consider metrics such as funds from operations, FFO, net asset value, NAV, and occupancy rates. FFO is a key indicator of a REIT's cash flow, while NAV gives insight into the value of its underlying assets. Tax implications of REIT. Investing in REITs comes with specific tax implications. Tax treatment of dividends. Dividends from REITs are generally taxed as ordinary income, which can be higher than the capital gains tax rate. However, some investors may benefit from the 20% deduction on qualified business income under the Tax Cuts and Jobs Act. Advantages. One advantage of investing in REITs is that they allow you to invest in real estate without the burdens of direct property ownership, including property taxes and maintenance costs. Future trends in the REIT market. As we look ahead, here are some future trends in the REIT market. Technological advancements. Technology is reshaping how real estate operates. REITs that embrace technology to enhance property management, tenant experience, and operational efficiency may have a competitive edge. Economic trends. Factors like inflation, interest rates, and demographic changes will continue to influence the performance of our REITs. For example, an aging population may increase demand for healthcare and senior living facilities. Emerging sectors. Sectors such as data centers, logistics, and healthcare REITs are gaining traction. As e-commerce continues to grow, logistics and warehouse spaces are becoming increasingly valuable. Conclusion. In conclusion, REITs present a unique opportunity for investors looking to diversify their portfolios and generate income without the complexities of direct property ownership. By understanding how they work, the benefits and risks associated with them, and how to navigate the investment landscape, you can make informed decisions that align with your financial goals. Thank you for joining us today. If you found this video helpful, don't forget to like, comment, and share. And remember to subscribe to Muscular Brain Fat Wallet for more insightful content on financial intelligence, investing strategies, and personal growth.